Difference between cash flow and profit. This video is going to look at the difference between cash flow and profit and hopefully enable you to understand the key term, liquidity. So what is cash flow? Cash flow is the money that goes into and out of a business. Typically we have inflows and we have outflows. And profit is calculated by doing revenue minus costs. There you can see a distinct difference between the two terms. Now that brings us this term, liquidity. Now liquidity is how much cash an enterprise has available. Now the best form of cash is strangely physical cash because you can use it to pay off any debts instantly. Then you have your debtors or your trade payables, people who you've given them time to pay you. So for example, I may sell my mobile phone to someone now and I say pay me in 30 days time. That makes them a debtor because they technically should give me my £500 for my mobile phone in 30 days time. You would hope they would do, but it's not 100% certain, and that's why it's not as good as cash. Sometimes they're called debtors, sometimes they're called trade payables. And also we have stock. And of course stock can be sold, but to sell stock quickly may mean that we have to lower the price of the stock. A company, when it does not have enough cash available, is said to have a liquidity problem. Now cash is vitally important for a business, as if it doesn't have enough cash then it's unable to pay its bills. For example, imagine that I've got £1,000 in the bank, but I actually have to pay £1,500 tomorrow in the form of a bill payment. I have a liquidity problem. I am short by £500. So let's take that example and let's now try and put it into a cash flow forecast so that you can see an example of where a liquidity problem is happening. So if you look in the month of January, you can see my net monthly is negative 1,500. And you can see my closing balance is negative 500. So I am overdrawn by £500. I need to arrange an overdraft with the bank to solve my liquidity problem. If I couldn't arrange that overdraft with the bank, I'd have a serious liquidity problem where I was unable to pay my bills and I'd need to find some other solution. Now, there are other solutions, but every solution stems from doing one of the other, either reducing costs or increasing revenue. So I may increase revenue by charging more for my products and services, but then I'd need to factor in whether that would cost me sales, or I could look to reduce my costs. Of course, again, I'd need to factor in whether that would impact on the quality of the product produced and the sales that I make. Some of the other solutions we could use in this case could be delay payment of that £1,500 until February. If you notice in the example, I was due to be paid £2,000 in February, so if I could delay that payment and make it in February, that means that I'd actually have a positive finishing and closing balance for the month of £500, and I wouldn't have a negative £500 in January, so I'd have no liquidity problem. Or I could look to try and get that £2,000 that I'm owed in February paid to me in January, and how I might do that is by offering an early payment discount. For example, I might say that you pay me £1,800 now and I will then basically write off your debt with me and I will also give you a discount. That discount of course costs me money, but it would still give me a positive closing balance of £300 and means I can make payment for my bill. Or of course I could just try and arrange some credit from my supplier. So rather than pay them in January, say give me 30 days, let me pay you in February. And that solves all my problems. But it's really important to remember that even though this business has got a liquidity problem, it's actually profitable. Look at the closing balance for March. It actually ends in a positive closing balance. It only has a liquidity problem at one point in the business's time of trading. So profitable businesses can have a liquidity problem. And that's a key point to remember.